Hello everyone, and how's it going? In this video, we're going to be talking about META Materials, trading under the ticker symbol MMAT on the Nasdaq. So, META Material MMAT is a company specialized in holography, lithography, and wireless sensing. It has attracted investors because it does offer high added value with its products, and it's attracting traders for its price volatilities. The price action has received a lot of downward pressure, that's for sure, mostly due to substantial market mood shift. What do I mean by this is that when the market believes that the overall economy is in rough shape, or when there is a hyperinflation going on, in fact, not even hyperinflation, as long as we have inflation going on, this is reason enough for many people to not get involved into high-risk areas of the financial system, namely growth stocks, financial stock, fintech, anything that's their valuation is based on what we imagine their value is going to be a few years from now, sometimes maybe a few decades from now. So when people are not sure about whether this, wonderful outcome is going to occur, they have a tendency to just putting their money in the savings account. That is just the plain reality of how people react. MMAT has been trading well under $1 for some period now, and recently it has received a notice from the Nasdaq saying that if the situation doesn't change, it might be delisted in early 2023. Now, the price seems to have bottomed recently, but even then, it's very wobbly. It's still having difficulties to sustain itself above $1 unless there is a reverse split. So it may not be able to remain on Nasdaq with its fundamentals or the demand from the stock market alone. What a reverse split is basically dividing the current number of shares, amount of shares, by a certain factor, so that each share is worth more, but the total value of the equity or the capital at risk doesn't change. So picture we have a bowl of soup. The bowl of soup has a certain amount of grains or meat or veggies inside. Now we've poured in 5 more liters of water in that soup. It still has the same amount of stuff. It's just far bigger, or far large, or far smaller. You see what I mean? The number of shares doesn't really change the fact that there is a set amount of money in equity. A lot of companies would use this tactic when they have to remain on the Nasdaq, but they won't go to a takeoff just because, in order to stay in Nasdaq, everybody decides to pitch in, right? That's not going to happen. Or they're going to have super good results, which is going to prompt the stock to spike. This usually doesn't happen. And what actually happens is that those stocks would typically go through a reverse split so that their individual shares would worth more than $1. And then that would buy them more time. But usually when companies do this, this could be seen as a weakness because it means that you cannot really get it back to $1 on your own, right? So with all that being said, why do stocks want to stay on the Nasdaq? Very simply, because they want to stay on one of the hottest stock markets in the world. And this allows them to have valuation models that they would probably not be able to get elsewhere. For example, when you trade most stocks these days, most of them are listed on different exchanges, not just American exchanges, but European or Latin American or Central American exchanges as well. But none of these markets can attract that amount of liquidity to get in and or out of positions. So this is why they would mostly prefer to stay on a Nasdaq. One other thing, if they cannot remain on a Nasdaq, what they can do is to start trading over the counter, which is what we usually call the pink sheets. there's a lot less demand for those stocks. And also, like, a lot of institutional money won't even touch these with a 10-foot pole. All right. So when we look at the fundamentals, it looks like it's not difficult to predict that the fundamentals are going to improve in future. But currently, the fundamentals, in my opinion, is not the main factor. Like, they can announce that they have new contracts, more revenue streams, more of those like innovative products coming out. But the main factor seems to be that the global economy is probably going to enter into a recession in the context of high inflation as well. So capital has become more expensive, just like we can see this with our savings account or our guaranteed deposits or government bonds. Like, their yields went through the roof, right? So in this kind of context, I have to say, not that much money wants to be poured into MMAT when you can be guaranteed like a 5 or 6% return on a almost risk-free, or at least perceived as such, elsewhere in the market. So there's another question as well. Is now the time to grab MMAT for cheap? This really entirely depends on what you're looking for. If you're looking for a good company to hold long-term, and if you believe in what MMAT does, and if you think that what it does makes sense to you, then definitely go for it. I do believe that now the market is kind of saying things are going to get rough, so I'm going to prepare for this rough scenario. In other words, they are preparing for one of the relatively pessimistic scenarios. And because of this, I believe that they're not going to go much further down unless the market is spooked. Because we have to remember, those movements are results of expectations, right? Generally speaking, if the market jumps up or down very quickly in a very short period of time, it's not because things are necessarily very bad, as long as they predicted it so. Like, it might have gone down sharply beforehand, a year ago or a couple of months ago, right? But when these events actually happen, if they were predicted, it's almost like, you know, the expression selling the news? So they're not necessarily going to keep going down. But people would be like, oh, you know what? The thing that everybody said was going to happen now happened. So now we're going to move on to other things. So this is a possibility as well. My point is, right now, everyone is saying we're due for a deep recession. So when the deep recession actually happens, it doesn't mean that stocks like MMAT are going to keep collapsing. They might grind lower, but unless like MMAT has some serious issue that we don't know at this moment, this is not going to matter that much. Now, the other thing is, if you're looking to trade the stock short or midterm, then I would say, yes, it is a good idea to go in now, but you have to maintain a very strict buying discipline. You have to control how much exposure you want to get into MMAT. From where it's looking at, I would say that the future baseline is going to be higher than where it has been over the past few weeks and months. On the other hand, we really have to wait to see if MMAT can get above $1. If it can, this would mean that they don't have to go through a reverse stock split. It sends a positive message to its existing shareholders. It's also sending a message to people who are considering buying it. Like people who believe that, well, it's a question of time, right? So if the time is now, I'm going to buy it now. Like, I believe that if it gets above $1, it tells people that it has bottomed now and that it's going to stay on the NASDAQ. It might be able to weather the storm. Now, before I go forward, it just occurred to me, sometimes people ask me, yeah, but you know, why don't you talk about this event or that event? Like they've received new clients, they've signed off new deals, they acquired new competitors and so on. I would say that for these news, one, they tend to be like priced in the stock price beforehand. Like there will be some kind of expectation that this sort of event would occur if they have a tendency to occur. The second thing is, very often fundamentals would matter at a modest level. Like it matters maybe 20 to 30% under normal circumstances. They would always work when the market is good. In other words, their CEO posts an Instagram photo. This might be the excuse for the stock to go up. All right? If things are doing poorly, then they can announce all day long that they're getting new clients, that they're rolling out new models, that they're signing with strategic partners, whatever that means. Well, they can do all of these, but as long as the market is not responding to it, it's kind of irrelevant. And the market, at the moment, at least as far as MMAT is concerned, doesn't seem to care that much about what it does. So the next question that we should ask ourselves is, will MMAT get new oxygen coming down the pipeline? So I would say that the more time passes, the more likely that this kind of thing occurs. But with that being said, we have to assume that in the foreseeable future, nothing is going to happen. MMAT is not in something that's really new either, right? It's not bleeding edge of the technology. I mean, they can claim that all they want, but ultimately, this is not something that can wow the shareholders. This is not something that you can talk about in your TEDx talk. This is not something that you can create a YouTube channel about and just become super famous. This is not the kind of stuff that is cool. And why is that relevant? Because amongst its shareholders, it's mostly retail traders, or retail shareholders, if you will. Most institutional money does not want to get involved in MMAT. So how cool your products seem to be actually matters because of the crowd mentality. One final element, and this one is even more open-ended, and I'm going to leave in as a food for thought. Is it possible that one day the sector that MMAT is in is going to get affected by a valuation revamp, if you will? Like a lot of those sectors, they have their head honchos that's really popular. And this is what pulls a whole bunch of other stocks in the same sector. For example, the EV sector has Tesla. This has a tendency to guarantee that whatever EV company you're putting together, and I'm using EV as with quotations here. So, I mean, it's always going to get valued differently to traditional auto manufacturers, right? Tesla is not and will not be valued like Toyota, like Ford, like GM. Does it mean that it's never going to be like this? No, nothing guarantees that. But this is an unlikely scenario. FinTech has SoFi. Big Data has Snowflake and Palantir. Now, I'm not saying that those companies are all doing well, because they're not. Maybe except Tesla. But what I'm saying is, those companies, they need to have a company that is very interesting, that captivates people's imagination, so that the other companies in the same sector can get the same kind of aura. Okay? For the moment, I don't see this with MMAT. Never, of course, keep in mind that this could potentially change in the future. So, does MMAT belong to a sector with plenty of promises, with huge growth potentials? Despite of what I just said, it's still possible. If microchips, defense systems, all these kinds of very high valued assets and products could trigger once again some sort of attraction from the shareholders. So, do you guys still remember North American Tanker? Is there anything that's remotely interesting about it, other than the fact that it's an oil tank company? But you see, in special periods of time, those companies tend to do very well. So just to conclude, I think that MMAT has a true potential ahead of itself. I think that this company can do well if we give it enough time. I think that if you believe in the long-term future of MMAT, I'm sort of a little bit on the fence with this. So I would say maybe a solid 6 out of 10. But if you're more than, let's say, 8 out of 10 on this company, now is a decent entry point. But if your aim is to speculate in a matter of months, then I would say maybe consider to slowly DCA in. If you're buying this company to hold it for the long term, regardless of if it can remain on a NASDAQ, if it goes on the pink sheets, so on and so forth, if none of these really matter to you, you believe that this company is going to do well, then you can buy all of these in now and just hold it as a marginal portion of your portfolio. It's like the moonshot portion of your portfolio. So I would recommend to commit a maximum 0.5 to 1% of your portfolio's capital in a stock like MMAT. Now, given the current market environment, I believe that the equity market is in a vast phase of correction, especially when it comes to tech and growth type equities. The financial market has been living and breathing thanks to the continuous creation of new capital, with different waves of quantitative easings, which will have consequences on the price of assets as well as their yields. With the interest rates kept relatively low over the years and the increase of amount of capital in circulation, this will keep putting significant pressure on the profit that we can expect the investment products across the board. And this, by the way, is a reality that may shift in the years to come if the interest rate of core infrastructures within our globally financialized system increases. It's useful to remember that the market doesn't represent the real economy, and of course, the real economy doesn't always reflect in the stock performance, since the name of the game here is ultimately called supply and demand, which depends on a whole bunch of factors that go way beyond our own control. If we think about it, this is like saying, if your neighborhood house that is put up for sale is only allowing those who actually want to live inside to buy it, versus if you allow every single type of buyer with different intent or reasons to buy or to sell it. So obviously, there will be a significant difference in the price of this asset for those two scenarios. The market currently works more like the second option, and assuming that it would only reflect the fundamentals of the underlying economy would correspond to the first option. There are a few elements that are considered to be the reasons. The first one is the significant increase of amount of money printed by the central banks around the world, which is then distributed to the banks, with the expectation that they will be loaned to businesses. Normally that's a good thing, but with a lack of opportunities in the real economy, the significant portion of that money actually went back to the financial system to buy up the price of existing assets. Now that the QEs have been wrapping up, or ended around the world, I think that this drive behind asset price may no longer be as relevant as it is right now for the future. It is now compensated by the arrival of capital from one region to another, and from one sector to another even within the same jurisdiction. With the increase of tensions around the world, capital is always looking for a safe haven to park their money into, not just for a place to grow the nominal value, but with a currency that tends to keep its purchasing power as well. The third factor is the creation or the birth of artificial bubbles, either maintained by the market trends built up over the years or out of necessity. Capital needs to find a place to stay. Some good examples of this would include the EV sector in the 2020 and the oil and gas securities when there are tensions around the world. Either way, when it comes to the price trends of the market, the degree of uncertainty is a key drive behind the price fluctuations, and that is likely going to increase as we go on from there. When companies announce that they are going to enter or exit different markets, or that they will be trading on different platforms and exchanges, this can all have significant ramifications on the price of this asset. Some of the considerations to have when operating in this context include having a clear view of what is going on, especially regarding the cash flow and the capital flow, and avoid certain potential pitfalls. One of these is to be careful with short positions. Inherently, short positions are riskier than long positions as the downside of long positions is limited, whereas the short positions can lose you as much money as the stock price may reach, which is infinite. On top of that, we're now seeing a new phenomenon with short squeezes, involving a group of retail traders propping the stock price up, forcing short sellers to recover their positions. Sometimes the attempt will not succeed, but sometimes they end up in very spectacular success. Something else to consider is to treat tech stocks with care. To start, ask questions when the price of a security skyrockets without real fundamentals. It doesn't mean that you shouldn't be touching it with a 10-foot pole, but it does mean that there should be a difference between the decision of long-term holding and short-term trading. Either way, a rule of thumb is that each position should be structured in a way so that their individual performances will never affect the portfolio's stability. Thank you for watching. If you like my content, please like, comment, and subscribe to my channel.